Welcome back to my channel, everyone. Thank you for tuning in. And in this video, we're going to be going over how trading is like a science. Trading should be very systematic, and basically you're setting yourself up for success if you do treat it systematically, like how I'm going to explain in this video. It's going to be a very good psychology lesson, and I know a lot of people do not like these type of videos. They just want to learn how to make money. They don't care about the mental side. But in my opinion, you're only going to be as good as a trader is to how strong your mental game is. So I hope this video helps out, and I hope I could help improve your psychological side to trading. So if you do enjoy this video and you learn anything from it, all I ask is if you were to drop a like on this video, subscribe to my channel, and also if you would follow my Instagram. I will link this in the description below. I post daily trade recaps, and I do some good trading tips and tricks. So without further ado, let's get right into the video. So you could watch the market, you could hypothesize, you could call out trades all day long. But if you're not actually executing your idea, the strategy, the plan, then what are you doing? You're definitely not trading. Same thing in the business world. You could have the greatest ideas, but if they're not executed properly, then what are they worth? It's worth nothing. A great running back could run the ball really well, but if his line doesn't block him, he's never going to be able to score. Same thing with trading. You could spend all the time in the world thinking about getting into the market, but if you're not ready to execute and manage the trade plan, then you aren't even trading. You're not even playing in this case. You're the spectator. And in trading, you have to be a player, not the spectator. Be on the field. Do not be in the stands. And trading execution is much larger part of success than most people think. A lot of traders are scared to pull the trigger and put risk on the table. But with no risk, there's going to be no reward. And that's with anything in life. Don't be scared to pull the trigger. Be ready to execute whenever the opportunities present themselves. And now we're going to get into how trading is like a science. This is very important. So trading is very simple. Traders are the ones that make it very complicated. Every trade is either going to win or it's going to lose. It's a 50-50 shot. Every trade begins with perception or idea that the value of an instrument that you're trading, whether it be a stock, the option, a future, the idea that the value of that instrument will be trading at a different value at some point in the future. Every trade that we put on is going to form an idea that which the current price we're trading at, we're going to hypothesize that we're going to be trading at a different price in the future. So you could look at trading in this context that every trade is a hypothesis, nothing else. We don't know the outcome. We're just going to hypothesize what the outcome is going to be. Now, if you remember back from science class, every hypothesis is either going to be supported or not supported. It has distinct terms to what to expect from the plan, what's going to be done if proven wrong, what will be needed to be done if we're proven right. And in trading in this case, it all relates to our plan and either if it's going to work out or it's not going to work. As the markets move up and down in price and value, it's going to provide extra support to a hypothesis for confirmation or disconfirmation, whether we're right or wrong. As the trade does unfold and we receive market-generated information, we're either going to be proven right or wrong from our original trade plan. So I want you all to think of a stop-loss level as an area or basically the outcome that's going to falsify our hypothesis. Now think of an exit point, a clearly defined target level, as a point or an outcome which is going to prove our hypothesis right. It's the opposite side to our stop loss. So the target, our clearly defined target area, is going to be the best possible movement if the hypothesis is right, where we're going to make the most profit, while our stop loss is going to capture the max risk that we're willing to take prior to exiting the trade if we are wrong on our original hypothesis. So a trader who lacks clearly defined targets and a stop loss level is like a scientist who lacks a clear hypothesis in the lab. If a scientist doesn't have a clear hypothesis, he's never going to know the outcomes of the experiment in the lab. Same thing with the trader. If you do not have a clear stop loss, where are you going to exit if you're wrong and where are you going to exit if you're right, you're basically going to go into the trade with unknown outcomes. Every trade should be put on with known outcomes, whether you are right or wrong. I'm going to lose this much if I'm wrong. I'm going to make this much if I'm right. So we have a hypothesis, which is going to include at what point do we think that the value is going to change And then with a hypothesis, without a hypothesis, we do not have the basis for executing our trade. So basically look at a hypothesis as our trading plan. If we do not have a trading plan, we have zero reason to put the trade on. I will never enter a position if I do not have a plan. If you put on a trade with no reason based on intuition, you think the stock's going to go up or down, then more than likely than not, you're going to lose in that trade and you have zero business putting that trade on. I'm going to get into that in the next slide. But you're going to have good execution on a trade if you enter at a price where the amount of money that we're going to be risking if we are wrong is less than the amount of money if we are right. And that's our target versus our stop loss. So the stop loss point based on our entry has to be smaller than from where our entry is to our target. That is a risk to reward. So when we talk about a good price, and when I say, good execution, good price, I'm talking about entering with very little risk with a much higher reward. A lot of traders I see that, they enter the market and place their risk at a certain dollar amount. I have a $1,000 account. I only want to risk $200 on this trade. So they put their stop loss at a point where they're risking $200 rather than a point where it makes sense on a chart that it's going to tell you that our hypothesis is wrong. Good execution means you calibrate the risk as your reward. Terrible execution means you calculate risk based on a function of how much money you're willing to lose. So here's an example of Boeing, and this is what you have to do before you put on any trade. Does not matter which strategy you use. Before you put any trade on, your hypothesis has to be written down, whatever, implemented in your head, but you just have to have an area where your stop is and where your clearly defined target is for you to complete that hypothesis, and then you put that trade on and you do not deviate away from that hypothesis. So in this case, Boeing sold off right into demand. We wanted to take this long with confirmation that we came out of demand, and when we form new demand, let's say we take this thing long somewhere in this area right here. So we get long around the 162.70 point, and let's just say our stop loss is below low a day, which is about 161. So we're risking about $1.70, and the closest supply zone is around the 168.30 mark, which is up here. So right now, if we enter, here, our stop loss is here, and our defined target is up here. So we're risking about $1.60 to make about $6 or $5.50 profit, which is very good risk to reward. It's like 4 to 1. I don't know exactly, but let's just call it 4 to 1 in this case. So we're risking our stop loss level is much less in a dollar amount, which we're risking, to our potential reward, which is our clearly defined target, which is much higher between the two. So before every trade is put on, this has to be planned out, written down, or whatever, engraved in your head. Then you put the trade on and then you let it work itself out. You do nothing. You're either going to be wrong or you're going to be right. The hypothesis is planned out, so you know both outcomes. If you're wrong, you're going to know how much you're going to lose. And if you're right, you're going to know how much you're rewarded. You can do this out of 10 times and still lose 6 or 7 or 8 times. And your 3 winners, your 2 winners, your 4 winners out of the 10 trades, you're still going to be a profitable trader because you're implementing this. It's a science, and your trade should be, you should trade like a robot. It's all systematic and it's done for you. You're supposed to think less during a trade, or you're supposed to do more or do less and think less during a trade. That's my motto. Think less and you do less. Let the trade work itself out. The more you try to control the situation, the more you try to focus tick by tick, the more you're going to try to deviate away from your original hypothesis, and the more your fear, your greed is going to influence your trading decisions. So we're going to wrap this video up, but I just want to leave you with a couple key points. So good execution is all about patience. I call it patience because you get paid for being patient. It's all about waiting for the right setup to present itself. And then don't trade the market. Instead, trade your setups. My goal when I'm trading the market is looking for my setups. My goal is to not look at everything that's moving. It's only to look for my setups that I know is proven to work. Think about it like poker. You only want to bet when the odds are in your favor. When you bet when they're not in your favor, that's basically gambling. And when they're not in your favor, you're basically trading something, you're putting on a trade that's not in your plan, that's not in something that you tested, and it's not your edge. That's gambling. Think about it like this, when you're trading, do not take every opportunity if a stock is coming up or down. You see it ripping, don't chase it to the upside if it does not follow your plan. Only follow your setups because your setups are your plan. That gives you your edge. It's been tested to work in the past and it's proven to work in the long run. And then the last point is you only get paid for opportunity in trading. You do not get paid for time. It's not like any other job where you work for 6 hours and get paid. You could sit in front of a computer for 6 hours, not put one trade on, and you're not going to get paid. You only get paid for opportunity. I see I just spelled that wrong. There's supposed to be an O in there. You only get paid for opportunity, not time. So that's your goal, to be patient, to wait long enough for the highest probability setups to present themselves. So I hope you guys enjoyed this video. Drop a like, comment, follow me on Instagram, and subscribe to my channel. Thank you.